Hello everyone, Steve Lentz here. Welcome to the Mentor Series. This one is entitled TradeFinder Challenge. It is September 30th, 2013. Presented material today is for educational purposes only and should not be construed as personalized financial advice. What we're going to do today, folks, and thanks again for joining us, is we are going to engage a feature in OptionVue called TradeFinder. And what it does is it finds the best options trade given that your target for an underlying does in fact come to pass. And so we're going to explore some of the parameters in which it finds good trades, and then we're going to take your symbols. If you have a symbol that you're bullish, bearish, or neutral on, we're going to take your symbols, and you could even, if you want, start even inputting those now down in the bottom right corner so that you could be first in the queue, as they say in other parts of the world, first in line. And we'll just take them top to bottom, first to last, and see how it goes. Now, before we dive into this, now what we're going to do, before we dive in, I want to just remind you guys that here at Discover Options, we specialize in one-on-one mentoring. We have a fantastic program whereby we can take an intermediate beginner-type trader and take you to an advanced level in about as fast of time as is possible, depending on your ambition and your schedule. And so we have a curriculum to help you get there, level 1, 2, and 3, plus a futures curriculum. And we've bundled these in various aspects. Level 1 is for those that are kind of getting started in options, or for money managers who are managing a portfolio of long stocks or mutual funds, and you want to have an options overlay to help you out. Level 2 is for the directional option spread traders, and level 3 is for the non-directional option traders. Condors, butterflies, calendars, those that want to make money no matter which way the market goes. It's a bit more advanced. We dive into volatility quite a bit, and in all sections, of course, we do cover money management in great detail. Before we get to TradeFinder, I want to remind you we also have a futures curriculum for one-on-one mentoring. Ken Dole and Paul Forcioni teach this. And in level 2 and this one, we dive into the Greeks quite a bit. Right here, we have a Greeks, as well as volatility, directional spread trading, trend trading, then the non-directional stuff, of course, and then as well as money management. And so if you're at all interested in options education and you want to get to an advanced level in as fast of a fashion as possible, give us a shout. We'd love to hear from you, and we'd love to piece together a curriculum that makes sense for you. Okie dokie. Now, let's go to the TradeFinder Challenge. What I'm going to do for a few minutes before we get to your symbols is I want to define the concept of expected return, ER. Expected return. And then after that, we'll have the information in front of us to then define best case return and worst case return. TradeFinder uses these three concepts in a great degree to rank trades. So we're going to have to make sure we flush that out and we understand completely what those three concepts are. Then we're going to take your symbols and we're going to go into TradeFinder on my machine, and we're going to go crazy here, all right? All right, here we go. Let's say that we're looking at Apple, and I'm just showing you here a single date target range between 455 and 505, something like that, and that's as of October 26th. Okay, remember, TradeFinder requires, let me repeat that, requires you to input a target. You can't just say generally bullish, generally bearish. It requires you to actually physically input a target for where you think a stock, futures, or index is going to go. Then it can go to town and start finding trades. Here's an example of one target. You could choose a target into the future, and there's a price range on it. A single date, but with a price range. Now what OptionVue is going to do, it's going to look for the best trade that makes the most average return out at that time. Okay, one trade it might come up with What is that in the background? It's bleeding through almost. That's just really weird. One trade that it could come up with is a condor. All right, and let me show you this. If we blow this up, okay, so I'm taking a look at this risk graph. You can clearly see just a real simple credit spread in the puts, credit spread in the calls way out there. And as of October 26th in the future, okay, between 505 and 455, okay, no matter which way it goes, if it ends up within those two price areas, it will make money. It'll make $397, okay, across that entire spectrum of price possibilities. So no matter where it lies at the end of this, as long as it finishes up with, on that line somewhere, you'll make $397 at that date in the future on October 26th. Now, what OptionVue does to find the target-based expected return, it's going to take that target, okay, for 455 to 505, and it's going to find 11 possible profit points along this line here, this red line up here. And it starts by looking at the one on the edge, on the far right edge right here. It looks at the one on the left edge, and then it looks at 9 in between there, equidistant from each other. Okay, now in this case, if you ran that, you'd get $397 at each of those 11 data points. It then averages these up, and watch this on the left here. Expected return, $397. Okay, now that's real simple. That's a real simple example of a single date price range target. Let's get a little more advanced now. Let's say that you're going to peg Apple to go into this box here between 455 and 505, and it's going to enter that box and finish in the box between October 10th and October 26th. That's the date range. The price range is staying the same. And by the way, in OptionVue, you could go here and grab this little target box and shape that box and drag it around as far out in the future as you want, and you can make it as tall or as slender as you want and position it anywhere. Okay, now as you do that, the price range will change and the date range will change. Okay, now, how do we calculate expected return when you have a completed box like this? All right, let's go over here, and we're starting out 10 days in the future at T plus 10. That's this little line here, T plus 17, T plus 26. T plus 26 is the one out here. Okay, here's what we do. We take an average of 33 possible profit points, not just 11, but 33 divided between those 3 date ranges. The most distant date, the most nearby date, and then also one in between. Now let's look at how this works. So we go to the most distant date, October 26th. Okay, October 26th, that's the expiration line here. And you can see at each one of those little data points, 397. Real simple. The average of those 11 was 397. Real simple. Then what do? Okay, we go to the one in between. And in this case, you could see down here, October 17th, 72 corresponds to that one, and that goes right here. Then we have 156, 216, 257, etc., all the way down. So on that date in the future, the average was 213. Now what are we going to do? Okay, we're going to basically, now we're going to go to the front part of our box right here, and we're going to run that same analysis right there. $5, see that? 67, 123, etc. So what we're doing is basically, now let me just, before I give you the punchline here, let me just go ahead and let's do this. Let's grab this. So we're taking, let's see here, okay. So we're taking a line here, calculating those 11 data points, a line at the far end of the box, and then one right in the middle. And we're running 11 data points on each of those 3 red lines in the future, seeing what the profit and loss would be at each of those places, and then averaging it up. So here we are with the near date, and we can see here on, we don't make as much money on that one, but it is a positive expected return at 128 average. If you average all that up, you end up with an average of all 33 of these at about $246. Now, let's look over here. Expected return, $245. I tell you, I spent more time than I should have just concluding that in the program here, like at 196, okay, this 196 really has some internal decimals after it. That's all I could figure. Or the number was 195.70 and it rounded up, that kind of thing. Generally, there's rounding going on that accounted for that $1 difference. Marty's saying, I thought you ran 11 by 11. No, we do it in 3 time frames. 3 time frames, the nearest date of the box, the distant one, and one in the middle. So that's how we get expected return. Now, so here's some concepts. I told you there were 3 concepts we needed. Expected return, which is what TradeFinder is going to really rely on. And then in our ranking, we need to understand best case return and worst case return. Now, here's what we do to find those. And TradeFinder really uses this a lot. If you look at all 33 of these numbers here, which one is the highest? Which one is the highest? And that would be our best case return. Our best case return in this situation is 397, as I use a fat marker and not a and not a more. Okay, best case return is 397. What's the lowest? What's the lowest here? Okay, $5. Okay, that's the lowest amount we're making out of all of these. Usually, when you run TradeFinder, not always, of course, but you will have somewhere in here a negative number. Okay, and it's simply going to be the worst case return that does the least damage. Okie dokie. All right, so with that knowledge, we're now going to go to TradeFinder. I'm going to share with you my desktop. We're going to come over here, okay, and we're going to scroll down to here. Let's hit insert a whole bunch of times. Come down here. Let's get some real-time data coming in. Activate quotes reception. And let's go look at the symbols that you guys wanted me to look at. All right, so from Michelle, we're going to look at SPX. From Joe, wants us to look at the 30-year bonds, ZB. What is that? Space. Oh, what is it? Here, where's my where's ZB? Let's go to Z3, okay? ZB space Z3. Okay. Jack wants us to look at CMG and SLB. Ralph wants us to look, he's bearish on Facebook. Bearish on Facebook. And Stephen wants us to take a look at QCOR. Hello, QCOR. Okay, here are the earnings dates. This is a feature we just added here a few weeks ago with an upgrade we did, so you can see automatically when the next earnings is coming out. And let me look at any, nobody's chosen Tesla. All right. Robin wants us to look at Russell. Okay. All right, so let's just see if there's any, so Michelle didn't really say. Now, if you guys, so Michelle, if you could, let's just take a look at the SPX. Thing is I could come up with the target, or you could give me a bullish or bearish target. That would be really helpful. We're all going to have differing opinions, and there's certainly so many different ways to analyze this. But let's just say, because I want to kind of customize it to you. If you suggested the symbol and you're actually looking at doing something, you know, we want to, you know, accommodate you as best as we can here. So we can kind of see here that this thing was, well, just look at this interesting channel. Spent most of the time in this channel here, and we cut it in half, and we're right in the middle. So channel analysis doesn't really net us anything, does it? No. So let's bring up some other tools. Let's look at MACD, and let's look at a little calendar thing. Let's look at MACD, and so we can see that the momentum is down there, and then let's bring in some just standard moving averages. So the momentum is down. The short-term moving average, the 13, is flat, and the other one's kind of going up. Now, if we go to a weekly, boy, we can hardly even see that. The weekly momentum looks flattish. Everything else is kind of trending upward. So this is just this is the momentum approach to looking at things. You know, it almost appears like, you know, very on the daily here. You know, one last shot. Let's go to RSI to see if that gives us anything. Okay. Well, I'll tell you what, we had hidden divergence. For those of you into RSI, the RSI was making new lows at the same time that it was failing to make new lows. Is that right? No, it made a new low with today's low. Yep. So that isn't even with us. Honestly, there's nothing predictive on the daily here that I think we can hang our hat on. Okay, so let's see, resistance. Robin is suggesting a resistance level at 1730. Well, you know, that's just this isolated high up here. You could say, yeah, you know, I mean, it's going to take some push to get through there. Support at 1670. Well, that's pretty close. It's a pretty close thing. Let's just do this. Let's assume that we can't really decide, but we know we want to do some kind of a trade here. So we want to maybe just see if there's a good options trade to put on where it's going to stay within this box out to here maybe. Okay. We're saying that it's going to stay within the boundaries going out to this option, this X1, out to the support and resistance level. We're right in the middle. Okay, bullish support at 1635, something like that. So here we have the price range at 1625. We're just kind of going down. Okay, let's just take a look. The low at 1630, 1627. Okay, we'll put the box there. Maybe raise it up just a little. 1627. Yeah, let's leave it there. And then the upper range is at 1734. We're saying that the S&P will stay within there. What are you saying about the Bollinger Band? Here, let's go to a Bollinger Band. Yeah, and so we're right hitting on the moving average. It's all, you know, come back to the mean, basically. Yeah, nothing hugely predictive here. So here's what we're going to do. Let's just see how this works. We're going to go ahead and propose a, you know, let's just come out here to the next one. Let's say that this thing is going to stay in this box right here. let's bring up a matrix for the SPX. We have to bring good data into the matrix. That's step one in doing this. We got to bring good data here. Now I'm doing 10-point strikes instead of going to the 5s and doing 10-pointers here. And I'm going to use no slippage, meaning that I really want to go after these market prices. Now look, in the SPX, you got to use limit orders to get the best price. Look at this 60-point spread, you know, on a $3 and that's just, you see how you would get creamed if you just put in market orders here? The open interest is nuts. The volume is nuts. But the spreads are really wide. Now the reason for that is because this thing's traded on one exchange. There's no competition going on from exchange to exchange. So the market makers there, and this is a true thing. This is true. They actually have a line of market makers waiting to take the next market order because it's just pure gravy and it's just automatic money with these widths of the spreads here. So you always use limit orders. We'll assume you're going to get something close to the midpoint between bid and ask at these market price levels. You should be able to do that when the open interest is in the thousands like this for all of these. Now the next thing we're going to do, I'm going to make sure that we have some commissions going on. Okay, so we're going to spend $1 a contract. And what you do is you go to TradeFinder here. We're going to bring in the SPX, go to the Assets tab, go to Targets. Our target box got imported in here right automatically. Strategies, I'm going to use all covered type strategies. Goals, let's go ahead and just apply 3,000. Won't include any existing positions. And then filters, minimum price to buy and sell, that should be simple. Let's just see what it comes up with. I have a minimum price to buy and sell, then the maximum days. You know what? I'm going to remove the filter on maximum days. If it goes out and finds something, let's just see what happens here. You ready? Let's hit go. Okay. And look at this. I'm going to suspend prices. And it found a butterfly here. 400 and look at this, 214 butterflies. And it's a tight butterfly. And it found these prices that were very tight to each other. That's why you want to add slippage perhaps. But when we analyze this, it found an automatic profit sitting there. And what you want to do is send the trade to the matrix, and you can see somewhere here it found that one of these was priced a little bit off. And indeed, just a 1% difference made it such that when you analyze this thing, okay, the T+0 line renders an immediate profit. If you can get these prices and then you sell it at the theoretical values, okay, you'll end up with $1,000 profit day one. And this is one of the reasons. Now I almost have to pull out the disclaimer paper and have you sign it, okay? Look at this. If OptionVue finds in this matrix options that are priced even 1% different, it's going to tee off on those and try and find a trade to take advantage of that, even with the big fat commission. And for that reason, I like to come in here and put in small slippage, because when you do that, now, when we rerun this, you'll find that that situation really isn't going to be the case anymore. It's going to assume a small degree of slippage on all three of those legs. And now look at the dramatic difference you get. Now we're down to an 8 lot. Okay? Much different. This is now much more normal. And so you got to run TradeFinder a couple times. I would say run it without slippage and then run it with slippage. And just see where you're at. Now here's a butterfly. Let's just analyze this thing. And look at that. This thing is really leaning it to the bearish side. And again, we have our, where's our profit? Well, you know, this is the shaded region. Let's get rid of this. The shaded region is the box, and we're not really looking, you know, three-dimensionally at these dates here. The dates in the box are really kind of farther out. Actually, we go 10/22. 11/5 is the distant one. And let's go, let's just say 10/29. Okay? So if I were to redo this, I'm going to go 10/22. 10/29. There we go. These are the three time frames that it's averaging the numbers. And then you even have some negative items over here. Okay? So on average, if this target comes to pass 1,000,000 times, on average, this trade will do the best in terms of expected return. That's how we ranked them, by expected return. Now, what I like to do is rank by expected return divided by the worst case return. Okay, that way we're going to get those that you can't lose on. Like, here's a credit spread. And you know, this is a bear call spread, way distant. Okay, now you might say to yourself, well, that expected return is kind of lousy. And when WCR goes positive, that kind of sends the results in a bit of a skew. And actually, we're internally talking about that. One thing to do would be to look at expected return and then go to rank them by expected return and then find a probability of profit that is above your particular threshold. Okay, maybe 71. Let's analyze that. And that looks a bit more balanced. Okay, that one looks a bit more balanced. Okay, now let's rank by probability of profit. And one way to do this might be to rank by probability of profit and then go to the first expected return that is at a 10% gain or better. Here's one that's close, not quite. Okay, let's just come back to that one. That one looks good. That's a condor. Analyze that. There you go. That one looks pretty good. The return is not quite 10% of that 3,000 we're going to put up, but that one looks okay. Okay, do you get the picture? Let's go to the next symbol in the list here. Let's go to Treasury bonds. Let's bring in some data, if we can. Oh, let's get some, activate quotes reception. Bring in some numbers. And where are we on that one? Treasury bonds. Joe. Joe, are you bullish or bearish on Treasury bonds? Take a look at the price charts. Wow. Okay. Well, this one's obviously quite bearish. We've had a retracement. We're probably looking at a rollover coming up. Let's say that you wanted to go bearish at this point. Let's see. You could, if you were to go bearish right now, I mean, what would your target be, I guess? One could say it's going to go retest this 128 and 128.5, say 128.5, and so let's just pull out our target box. Let's say that it's going to go retest this, and if it goes up to and surpasses, let's say if it goes up this high, we're going to get out. Okay. Now, how soon can it make this? Can it? Okay, let's use that as the box, shall we? All right, so now let's go to TradeFinder, Assets, ZB, Targets, Strategies, Goals. We'll use that. I'm going to go check out my futures. We're using a buck in and a buck out. Well, on those options, I think we're going to go 3 in, 3 out. I don't know what the commissions would be. Let's just make sure they're over a buck in and a buck out. Let's hit go and see what we get here. Now again, here, we're assuming no slippage. We're assuming that you're going to get these prices here. Let's suspend. We're assuming you're going to get those prices, and if you did, you have this butterfly sitting here. Now let's go to expected return, some fat worst case return there. That's why I'm looking at this one here. Okay, when we have all negative worst case returns, I like sorting by the ratio of expected to worst. That just seems to render a pretty good looking trade right there. Look at that. Not too bad. That's probably a pretty darn, good trade compared to what we could get. Let's look at the one with the highest expected return. Just simply the highest expected return. There it is. And we can flip-flop between the two, organize them by yield, and superimpose. We could see that in terms of, we can lose a bit more here, but that blue one really, boy, that one looks pretty good. That blue one is the one I like. We're not going to lose much money, and we're going to make pretty darn good yield if this thing turns out. Okay, so that's what I'm doing. I'm looking at the highest expected return, and then I'm ranking by expected to worst, making sure that the worst has a negative value. If there's any positive values, well, that kind of gums it up. Okay, and we're working on that, as I said, internally here. One little note. Now let's go and put in some slippage and see what that does for us. If we put in a small amount of slippage, rerun this thing. Let's see what that does. Yeah, different set of trades. Highest expected return is this one. Wow, very directional. Making some good money over there on the downside. ER divided by worst case. It's the condor again right there. Look at that. Okay, and hey, that's kind of interesting. All right, we can sort by yield, compare the two. Clearly, the condor makes money across the whole spectrum pretty well, especially by the end of the box. The other directional one, boy, you're taking a shot, but you can make 2, 3, 4 times your money over there down if it does go down. Okay, so that would be the that's the bonds. Okay, moving onward. Let's go to Chipotle, Mexican Grill, CMG. Jack is bullish on this. Bring in the matrix, get some good prices. Go to the price chart. Get rid of all the markings I made earlier. We're bullish. Look at today's breakout bar. Wow, that thing's making 1, 2, 3, 7-day highs. 8. How about multi-month highs here today? Fantastic breakout. Had a nice little move. It retraced, and today's a big breakout day. So let's go and let's position our target box just underneath that previous swing point. If price comes down past this swing point, I think our bullish premise is gone, right? I would assume so. Let's then take the box and slide it up and out. Come on, pull it out there. There we go. Something like that. let's see. Is that kind of the pace it can keep going? Here, let's move it even higher. There we go. Could go up at that pace right there. Robin is asking a question. Didn't these guys get upgraded today, or was that Panera Bread? I don't know. I haven't seen myself. Did you guys see, Jack? Did you see if these guys got upgraded? Let's go to TradeFinder, Assets. I click that little number 1 button to bring in the currently selected symbol. Go to Targets. There it is. That's the box. See, Roland says CMG got the upgrade. All right. We're going to start out with no slippage. Or excuse me, let's go to no slippage. Oh, no, that's bond still. Hang on it. Where are we? No. CMG. There it is. No slippage for starters. Okay. And then let's go to strategies, goals. Same thing here. Let's hit go. $142 calls. 1,500 debit spreads. You know, you see why we need to add in some slippage here. Get rid of some of these. Look at that. It found 2 options. Look at it'll do this. Look at that. It's finding a few options that have the same price, and it's just teeing off on that spread there. That's no good. Let me suspend prices. And let's just go after this. Send trade to the matrix. Where is that thing? There it is. Yeah, 2 options, technically having the same price. And one of these is going to be a bit over or undervalued. Oh, look at that. Oh, look at that. We're using uniform. This is a leftover vestige from earnings when I was analyzing earnings. And this is another great lesson for those of you OptionVue aficionados. If you like messing with the modeling like I do, quite often you finish up with a matrix, close it down, and leave, and you forget to come back and check your modeling out. You got to switch back to variable, okay? So now it can rerun this thing. We're going to rerun it using a normal model. Uniform model is something that you have to manually go to, and I did it when we were analyzing CMG's earnings. But of course, it doesn't remove the fact that we do have this little situation where we have the same option price, the same market price set up here. One is undervalued, one is overvalued, and so it's going to tee off on that aberration, the anomaly, the error, the pricing error, and it will tee off on it and just have you load the boat on that thing. Expected return is just crazy. Look at that. Clearly the highest expected return if you could get those prices. But we are wiser than that. We know we can't get that particular price, so we are going to make an adjustment and a correction. Or we could just simply ignore that. That's the other thing to do. But in any case, look at this, 750 butterflies. So let's send that to the matrix. Look at that down here. If we could get those prices, that would automatically get us, you know, immediately a $750 profit. All right, even after commissions, even after some crazy commissions, you know, really $2,000, $3,000 in commissions, that's crazy, right? So what are you going to do about this? Again, we need to come in here and add slippage. Now when we go and rerun TradeFinder, that should not be there anymore. Now I wonder if that little 1,000, you know, or the $2 options that we're lining up, if they're going to be the same. I doubt it, but let's just see what it comes up with. See, now we're no sound. Just waiting here. Sammy said there's no sound. I show that I have sound. No one else is saying anything. Okay, Robin can hear us. Okay, we're good. All right, so while this is coming, let's just see. We're going to rank by expected return. Just going long these calls is giving us the highest expected return on average. If we were to cut this to, see now we're having the WCR is all gummed up here, unfortunately, so we can't use that one because we have some positives. That's just a little unfortunate. So what we're going to do then in that case is go to expected return and look for some really low worst case returns. Here's one at minus 654. Okay. You know what? Let's go probability of profit. I'm going to go to the first ER that's in the hundreds. See if we can get anything up near. See, that's just not happening. Look at that. My goodness. Look at this. ER. Well, let's go to worst ranking by expected returns. Then we go to, here's one way to do it. Rank by expected returns. Go to the first probability of profit. Here's one over 50%. 50. Let's go to this one right here. Analyze that one. Okay, here's our target. Okay, kind of a short little target, in this case out in the future. You know, very narrow target is what I'm saying. Anything else? I don't know. This is not impressive. And you know, one thing, you could use TradeFinder. Here's one that's 65%. Let's analyze that. Now that's actually a bearish trade of all things, but the pricing worked out there, right? What about positive worst case returns? Robin, if you have a positive worst case return, okay, it's going to, when you rank by expected divided by worst case, the algorithm currently falls apart for some reason. Okay, here is a credit spread. Now let's just see here. The ratio of that to that. Oh, I see. No, now we have all negative worst case. So this is a good way to rank. Expected divided by worst case. Now that we did slippage, we now have all negative worst case returns. So this trade really probably is the best trade on average. We have a high expected return divided by a relatively low worst case return. And you can see we're not going to lose that much money over here, but we can make money indeed if it does go down in this case. Now, weren't we bullish? Theoretically, we were bullish, but this is where our target is. We could move the target around a little bit, okay, and come up with different results. But that's what it's going to do, is it's going to simply take your target range and, you know, silly computer, it just does what it's told. All right? General, is TradeFinder a good tool if you just want to look at credit spreads? Jack, yeah. And what you would do there, and let's do that. Let me show you how to do that. Go to Strategies, deselect all, and then just simply select credit spreads. Vertical credit spreads right there. Hit go, and it's only going to look for the credit spreads that would perform the best given that target comes to pass. And there it is right there. The one with the highest expected divided by the worst case return. And there you go. That's the best credit spread in terms of that parameter. Now this is a bear call spread. You might want to go to the first bull put spread, analyze that, and there you go. Okay, next symbol. SLB, Let's see. Neutral. Jack is neutral on SLB. Okay, October expiration 85 to 90. Let's go into the okay. You think it's going to end up between 85 and 90 as of October's expiration, I guess, right? So let's go up to 90, right around there. Now, okay, let's bring up the matrix. Let me show you another little nuance here that'll be kind of important. And let's suspend prices. All right. This thing has 19 days to go. You might only want trades in October, right? All right, so let's say that you know you want this, you're doing the price range as of October's expiration. You know you want only October trades. So remember, there's 19 days left in this. We go to TradeFinder, bring in SLB, brings in our targets, strategies. I'm going to select all covered. Goals, and let's go to filters. Now, maximum days to buy, we don't want to go anything over 19 days. And by doing it this way, we're limiting the trade ideas only to October, in which case it found nothing that makes sense. It found nothing that has a positive expected return except for shorting the underlying, if you can believe that. All right? So what do you do in that case? Okay, make sure we don't have slippage going on. We just don't have a whole lot of options to play with here, of course. So what else can we do? We can adjust the target as of October's expiration, but I don't think we want to do. And you might be saying, wait a minute, there's got to be a trade in here somewhere that has a positive expected return. Well, remember, this target is quite wide, given where we're at. Well, it is kind of bearish, come to think of it. That's why it has you shorten the underlying and getting a little bit of a better return, or a positive return. Why? Let's see here. What else can we do? Anything? We could say, I'm going to select all and even include the naked stuff and see what that can do. Let's see what that does. Minimum price to sell, 30 cents. Let's knock this down to a dime. I think we're filtering that out. Does that help us out at all? Not really. Not really. Nothing else has the expected return that's positive. So I'm going to get rid of this date parameter of 19 days. And I'm going to rerun this. And now that I got rid of that time filter requiring only October options, now it's finding all kinds of stuff out in November. So here's a butterfly in November that we can analyze. And yeah, when October expires, this is the November distant date in that from that box there. And that's the trade really that gives us this little butterfly here, 7,500, 87.5, 75, 87.5, 100 call. Okay, you analyze that. That's kind of where it's slightly bearish. Okay, slightly bearish. And we're doing it expected return divided by worst case. What's the highest expected? Here's another butterfly. There we go. This one is the 77.5, 85, 92.5. Okay, we'll take advantage of a bearish move, so that might be the one you want to tee off on right there, come to think of it. All right, let's see. But that includes earnings. Jack is saying what? What are you talking about? SLB? No. Yes? I just saw your thing. SLB, yeah, this thing now, Jack, this does not include earnings. That's correct. It's going to include earnings. Now, when is earnings on SLB? Let's go take a peek in our website here. Go to our stock analysis report, put in SLB. We can also look in OptionVue. Well, 4, 5, 6, 7, 8, 9, 10, 10/19 or so. It's not showing up here. If we were to come back here, SLB 10/18 before the market open. So 10/18, yep, that's coming out with earnings, and this is going to this butterfly will include earnings. Yep. Now, we could go ahead and try and filter this out at 19 days. Oops, timeout. But we saw that that target rendered us, nothing there. Nothing had an expected return out of all the possible trades. So the only thing to do there, Jack, would be to change the target. Okay, that would be the only thing to do. Okay, finally, Facebook. Oh, 3 more. Facebook. Let's go to Facebook. What are we bearish on Facebook, I think, right? We're bearish on Facebook because it's been taken off so darn fast. We're expecting this thing to reverse course, and it's riding the Bollinger Bands up. Kind of crazy. On the weekly, it's not yet outside that range. It's just riding it upwards. Closed above the Bollinger Band. Today, it's going to close underneath the Bollinger Band, that 2 standard deviation Bollinger Band. And so if you think it's going to revert back to the mean, okay, where would your target box go? Let's say that it reverts back to the mean and comes down at a pace like this. This is going to come up to here. So we're going to say it's going to revert to the mean about there. Okay. Let's see. And, you're going to give it another true range or so on the upside. And this is looking pretty... you might think that it's going to go down farther than that. Let's use a little Fibonacci thing. Let's say that you got, oh, come on, Steve. What is that? No. Let's grab this. You have this little swing. It's going to come down to halfway at about that pace. That's the target right there, right? So let's say it's going to come to there. And we're going to get out if it goes to there or so. How about that? And we'll go out almost to about right there. Okay, so we have a downward target. We're going to get out if it keeps, climbing, and hits and goes up above this area there. Okay, so let's see here. All right, let's go to Matrix. Bring in some real-time data. Okay, we've got some weeklies going on in here. October 26th. Okay. TradeFinder. Assets. Target. There's our box. Strategies. Select all covered. Goals. Filters. Hit go. Again, no slippage here. Robin is asking, did I filter out weeklies? I filtered out the 19 days. Anything under 19 days, anything over 19 days is filtered out. Okay, so I could get rid of that. In fact, I might want to do so. So let's actually, let's stop this. Let's go back to the matrix. October 19th, then the weeklies kick in. Let's get rid of these here. And with that done, that's going to take a whole nother period of time here. But it's finding these 37 puts. Let's just analyze this put here. See, it's finding that there's an automatic profit there, and where the theoretical price is at $1.57 and this one's at 70. Now, why do we have such high differences in theoretical price? This makes you have to go to the matrix and look at that down there. Doggone it, uniform again. So let me stop this, go to the matrix, go back to variable model. Now let's run it again using a variable model and not a goofy uniform. And so off we go now. Yeah, if you're into analyzing earnings and you switch to uniform very much, you got to make sure you go back and flip it back to variable, and it's a great idea to maybe have it revert automatically. So let's just see once what we get. Expected return. Here's the one with the highest expected return. And again, it found an option that is just inherently, look at that, 8 cents. This is 23 cents, these 48 puts. And it found those 48 puts, and it's teeing off on that. Let's send that trade to the matrix. And percent, well, it's not even a, oh, here, I have to freeze prices. The prices changed as we were speaking. Okay, let's hit it again. Okay, all right, there we go. Highest expected return. Let's analyze it. That one looks pretty good. Still, it's perceiving an edge there that's just coming from who knows where. That's just not quite. Yeah. Look at this, and now it's finding more. You know, when you come here and look, it's finding these that has this inherent edge. At price, theoretical, 47, 10% difference there. November 50 calls. That's interesting. Okay. This is a calendar spread. A NOV, a weekly, selling the weekly, buying the NOV, and this is probably coming from the weekly skew. Let's send this to the matrix and look at this. And this is the danger in having earnings go on, is that you have this weekly that's affected by earnings a lot, and this one is not affected. It will be affected, but it's more distant. So it's going to tee off on the horizontal skew here, and really play off on this. I think that's what's going on. Yep. No, look at that. No, it's not. We go to TradeFinder. We come in here, and it is really T plus 0. T plus 9, T plus 17. Yeah, it is, let's see, how did that, so if I send this trade to the matrix, what is going on here? 420 and 450. Send it to the matrix. Here they are. This thing is not overpriced, yet it's assuming, it's modeling it subject to, I think it's modeling it with some kind of a There's something called an implied event that might be gumming up the works. I'm going to add in slippage and just see if that takes care of this. All right. Should have gotten rid of collars. Then we're going to move on to the others. Why not always use slippage? Joe, sometimes, for some assets like spiders, you don't really need to. Because they are so liquid, you could pretty much get the mid price if it's only a penny wide, right? Okay, but in general, Joe, you have a point. I think you could just always have small slippage going on in TradeFinder. Robin, how is the IV in Facebook? Is it high or is it low? Let's just go take a look at Facebook. Well, it's relatively quite high right now. Relatively, I would say, Robin, it's quite high. It's in its 85th percentile. And again, we have this debit spread. And again, it's analyzing this. Well, I'm befuddled because we analyze it and it comes up with something here, 420, 450. As of today, you have this mispricing going on even after slippage, which is being factored in. Yet if we send it to the matrix and we analyze that proposed trade, it's down here. So I have some work to do to figure that one out. Something is, you know what, let me go see if I did anything in here. Okay, this is left over from what I was doing before. Oh, that's all I can think of. The 30-day vol is at 64, and then it drops to 55. Okay, this assumes, yeah, we're going to have to mess with the modeling here. Here's what's going on. This thing is assuming that as time goes on, the 59, this horizontal skew will kick in and this will rise. That's all I can think of. I don't know. Now I'm speculating. So sorry, I'm stumped. It's combining weeklies with the monthly, that's true. I am stumped on this. I'm going to have to go find out. It's 2 o'clock. Central. Okay. I will, next time you see me, we're going to analyze 2 o'clock Central on 9:30, because I'm going to do TradeFinder again when I'm up for again on the Mentor series, and we'll examine Facebook as of this date and time, and I'll have a good answer for us. Okay. Yeah, Ralph had trouble in Facebook calendars. Q-Core. All right, what's our opinion on Q-Core? Let's go take a peek. Let's see. Stephen, you think it's at 660.50? You think it's going to go to $60.50? I think that's what you're saying. You think it's going to go there short term? Okay, let's just take a look here. Big impulsive move down. Now it's chopping up. We can expect it to keep going down perhaps. And you got various trend lines and so forth here. Just busted through that one pretty strong. And if you take the target between there and reduce it from there down to 1, 2, 3 and a bit. 1, 2, 3, about right here is the target. So it's going to come down, and we would expect it to come down and hit this price right around here somewhere. Now, if it keeps going up and up and up, where are you going to get out? Let's say that you would expect this thing to chop about another average true range and a half or so. If you're bearish and you think it's going to go to the bottom of the box, you can come over here, come out to here, and put in a bearish trade at this point. And let's extend it beyond. Okay, let's go out a little bit more in time. Okay, give it some good time, and let's see once what we get. So we go to Q-Core, targets, matrix. Let's just go and do a small slippage. Bring in some prices. Okay. And okay. Strategies, goals, filters, hit go. And for that, here's a put debit spread. Here's our target way down there. Okay. Our target way down there. Okay. Boy, our target was kind of located. No, wait a minute. Where is this? Our target's down, but our we're up at 61-ish or so, right? Yep. Okay, so let's analyze by this. Analyze. There it is. Why does it say that the current price is at 65? Is that where we're at? I don't get this. We're not at 65. We are at 58. So when we analyze this thing, 58. Send trade to the matrix. Oh, I see. It was a, look at that, a covered short. Covered put. Very interesting. A covered right on the put side. That's an interesting thought. Okay, covered right on the put side, and then we were examining a debit spread. Send trade to the matrix and analyze. There you go. There you go. Which one do you like better? Go to yield, and kind of have to pick and choose here. You can make more money on the covered calls. You'll certainly lose more money than on the covered put. Then on the debit spread, you'd lose less money, but you wouldn't make as much. So then in OptionVue, you kind of can even go to one time frame, go to T plus 10, and just kind of see which trade works better. Using the bracket keys, you can then kind of expand it and see that the debit spread in blue probably, no, that's the covered put in blue, is going to outperform your debit spread in red. Covered put idea, very cool. Steven says he's in a covered call. Well, are you bullish or bearish, Steven? I assume you're bullish then. I went bearish side because we've had a big crush in price, and the thing's just chopping up, getting ready to appears to be getting ready to crash again. Steven's bullish. Well, if you're bullish, then let's, Steven, where's your stop going to be? Down here below this pivot point at, say, 54? Or do you want to go lower than that? Let's put it out something like that. Let's say 54 is the stop. Let's put it out here. Let's go to TradeFinder now. We have a new set of targets. And the one with the highest expected return is this calendar spread out here. In January, it's a Nov-Jan calendar spread. And if we do the more safer approach, we get a different calendar spread out here. Apparently there's some slippage. Even with that slippage, though, We can compare the two, and the two different calendar spread. One gives us a much greater return, but we do have some losses potential. The much safer one gives us a pretty good broad spectrum of profit possibilities, except if something happens immediately. We won't make up for that slippage. Okay, finally, we have the Russell. We have the Russell. Now, I think, was it Robin that gave us the Russell? Okay. Joe, have I ever used acceleration band? No. I use trend lines, the symmetry of trend lines. Joe is asking, how do you use TradeFinder to analyze a small group of candidates after you've picked the price points? Let's finish Russell, and I'm going to show you how we do that. So let's say that the Russell is one that we might think is topping out. Okay, and the reason it's topping out is we have RSI divergence in both the weekly chart as well as the daily chart, where you see price making new highs, the RSI failing to make new highs up there, and so now we can come in and put in a target box. Oops. Let's see, what is this? Target box. And let's give it a couple good true ranges above. Let's come down, and let's assume it's going to test the swing bottoms down here. Okay, something like that. Let's do something like that. And let me just see if Robin is saying 1100 to 1030. 1100 down to 1030. 1100 to 10. See, I'm looking at this. I'm getting close. Okay, very close. Well, that's a fairly neutral type position there. So I'll tell you what, let's just see what happens. Russell, targets, 1030, 1100. Okay, strategies, goals, filters, hit go. And you know what? Yeah, let me make sure I got prices. Yeah, there we go. Want to make sure we got some prices coming in. TradeFinder, hit go again. And it's teeing off on these. Where is it? Send trade to matrix. Oh, deep in the money. It found these deep in the money options to tee off on. I bet I don't have slippage. Slippage is set on small. Why is it teeing off on that? It's perceiving a bit of an edge. $945s, it's perceiving an edge on these 945s. Theoretical price. No, 133.85. TradeFinder, send trade to matrix. TradeFinder, analyze. 133. Okay. The at price 129.50. Okay, and then it's just coming up with a small little edge there. I have no explanation other than, well, here's one thing. You know, when you get too close to expiration, if you analyze this, this is very close to expiration where the whole butterfly can just really pop up. And you know, butterflies, if you're going to do this, you want to back off the butterfly from the expiration line as much as you safely can. That's why it's kind of sitting over there, and it's making some really strong returns showing up here. That's one reason it's now doing iron condors. And we have small slippage even set up here. Our range is very narrow. Okay, our range is very narrow, so here it's coming out and it's finding a butterfly that's really going to do very well. Okay, and if our target comes to pass, this butterfly will make money no matter where we are in that, within that target there. Okay, and so, you know, when you have a neutral strategy, it's close in, very narrow. Butterflies are going to be quite often the trade of choice if that does indeed come to pass. I'm intrigued by 750 contracts, though. It's spending a lot of money on the commissions. Holy smokes. It's still working on iron condors, notice. Oh, we don't have slippage. I thought we had slippage. Let me stop this. Set up slippage. I'm sorry, small slippage. And I'm going to come in here and select all covered. All right. Debit spreads. Okay, Robin, this will be much better. Okay, so I'm just going to read Marty's question here. I'm looking at Q-Core. Marty, did you input the same target we had for your Q-Core question? And Robin is asking, why are there no ratio spreads selected in the strategies? Okay, do you see this, Robin? It says vertical ratio spreads +1 and -2. If you sell two options and you go long one of them is considered naked and is not covered. And what I did is I selected all covered type strategies here. See that? And so I could select ratio spreads and we'll see what we get. But that's why it's coming up. So Marty is saying this is from your own screening. Oh, I see. So you just adjusted the bell curve. And your question is, how I have found an improvement on that in TradeFinder? Well, Marty, you'd want to input that target into TradeFinder and see if you can find a better trade. I don't know that I'm answering the question, but it makes sense. Everything you said makes sense there. Okay, Robin, so here we go with Russell. We're analyzing this. This is taking off on the directional aspect of this. What you can do is rank by expected return and then go find the one that has the higher probability of profit. Here's one at 59. That one might be the better one to look at right there. Okay, again, this is kind of a bearish look. The other way to do it would be to go to ratio of expected to worst. This will give you some higher probabilities. Here's a butterfly, a bit more neutral. Again, a bit bearish because your target is just a little bit bearish. Okay, I'll send that to the matrix so you can take a look. This is a very wide butterfly, as you can see here. 985, 1050, 1115 in October. Okay, now we're done. And the other thing to do, again, is rank by probability and find the first expected return that has a decent yield, something like, something in the hundreds of dollars, and of course there are none. Okay, yep, there are none. So of all these, I would say you'd probably want to pull this butterfly here that has the best ratio of expected to worst case, something like that. Okay, let's send that to the matrix so you can see that one. This is in the calls, I believe. There it is. Again, a very wide butterfly, 1,000, 1060, 1120. All right. Folks, boy, we've been at this an hour and 20 minutes. I appreciate you hanging with me. Again, when I'm back next time with you guys, we're going to continue with TradeFinder. Bring your symbols. Ideally, bring your targets. Maybe your questions for me will be more refined after this intro, but when I get together with you every month or so, this is my intention, is to use just to do a TradeFinder challenge with you, and we'll dive into the depths of TradeFinder. And I already have a nice little topic regarding Facebook calendars and the modeling thereof, and we'll discuss that next month, okay? Take care, folks. Have a great rest of the week. Bye-bye.